Premium financing by stacking or laddering policies has become something of kind of a fad here lately in the insurance world. So we wanted to take a moment and see how it works, but more importantly, is it even profitable? So taking a look at how it's supposed to work, the philosophy behind stacking or laddering policies is that one policy can become the funding source for another policy so that you can build more equity in life insurance. Very similar to what people teach in real estate courses, where you buy a piece of property, get it up, get it cash flowing, then leverage that piece of property to buy another one. And the same thing is taught by some that can happen with life insurance as well. So when we design a life insurance policy, there's two parts to it. There, especially when we're talking about participating whole life insurance policies, there's a base premium, and in this case here, it's $29.54. And then there's the paid up additional insurance premium. In this case, it's $7,045, which increases your paid up insurance, which is what increases the cash surrender value so rapidly in a policy. So as we look at what would be available to borrow from this policy, in year one, we can see it'd be $65.16. In year two, it'd be $13,261. Year three, it'd be $22,739. And we can see here that by year two, designing a policy like this, there would be enough cash value in this policy to borrow to fund another policy of $10,000. So this is the theory about how that would work. And we could go out and say that we could start leveraging or laddering or stacking in year two, or we could do it in year 3, 4, 5, 6, 7, 8. We could do it in year 15. And all of those are options. But the further out we get, the less we really see what it is costing us. And so we're going to start laddering or stacking in year two here. And as you can see, in year two, there's enough capital to borrow to fund policy two. And by year two, in the second policy, there's enough cash flow to borrow and fund policy three. Now, ideally, that's the way it would work. Okay? But this is what happens to the policy when you do that. When you borrow money from a policy, it reduces the amount of money that you can leverage against that policy. And so here in this case, if you surrender this policy, or what is left to borrow from this policy after you fund another policy with it in year two, is only $1,066. And if you continue to borrow the $10,000 from this first policy to fund the second one, then there is a premium that shows up that has to be paid as well, another $3,548 here. And still then, there's no cash value that is building up. Now, granted, you'll still earn dividends on the paid up insurance, even though you've already leveraged this policy to the max. But what happens if we don't borrow the $10,000? What if we only borrow enough to fund the difference between the paid up additions rider that we stop paying on the first policy and the base premium? So in that case, we're really only borrowing $29.54 to start our second policy. Well, then what happens is you're able to fund the second policy a little bit longer with the original cash value from policy one. But even by year 8, there is no cash value to borrow from anymore. And so now the premiums of these leveraged or stacked or laddered policies comes back to yours truly. And if you don't have capital that's been generating someplace else, then what's going to happen is that you're going to be in a position to lose money. And you could even be in a position where you have borrowed more from some policies than what you've paid for them, and that could leave you with some tax liability as well. This brings up the more important questions about stacking and laddering. Is it in your best interest? And number two, a lot of what is being taught is that by laddering or stacking or doing this unique type of premium financing, you'll be able to get more policies. And we have to ask, is more policies better than one larger policy? So those are the questions that we want to address as well. Now, thanks to my friend Duke Wilwaco down in Texas, this chart shows that the larger the premium on a life insurance policy, all things else being equal, death, your mortality risks like age and health and all those, the larger the premium you pay, the lower you actually pay for the insurance. And that has to do with the annual fee that you're paying on a life insurance policy. So if you have, just a certain amount of money that you're going to put into life insurance policies, it doesn't really make sense cost-wise to split that premium up and buy two policies, because now you have two annual fees. Putting all that money into one larger policy will save you money. In this case, if you're buying $100,000 of death benefit, you pay $1,493 for that. But if you increase the size of the policy and buy $150,000, the premium actually goes down by 10 cents per thousand. And so, yes, it makes a lot of sense to buy the largest policy that is comfortable and affordable for you rather than splitting the same dollar amount up into multiple policies, unless those policies are on different people. So you're insuring a husband and a wife so that both of you have a piece of insurance in case there is a need for the death benefit. At the other hand, we've got to look at the cost of insurance as we get older. Here we see the actual cost of the base coverage of insurance here per $1,000 when you're 30 is just a little over $10. But by the time you reach 61, it's almost 30. And so there is some importance, if you're going to continue to build equity in life insurance, to buy more policies sooner than later, simply because you don't want to see the cost of insurance nearly triple by the time you realize, oh, I really should have another policy. As you can see, buying a policy with a higher premium can save you money, and buying additional policies while you're younger can also save you money. But one thing that we need to really focus in on here is dividends cannot be counted on to offset policy loan interest. So if you're counting on the dividends to build the capital so that you can leverage one policy to purchase another, you're going to run into a brick wall sooner or later. And the conclusions we can draw from this are, we need to purchase the largest premium policy that is comfortable for you so that you get the best price on your insurance. And number two, add additional policies as you can afford them, and only as you can afford them. Don't try to leverage them by using capital from another policy or any other source of income that you're going to have to pay interest on, because you cannot rely on the dividend to replace that interest cost to you. And always plan to pay the premium and the policy loan interest from any policy loan that you take or any policy that you own directly from your own income stream, not depending on a life insurance policy to do that for you. Don't be fooled into believing that dividends will cover the cost of the interest on a policy loan. In our low interest environment, dividends may not help you to recapture all the money you spend on a policy loan. So here are some facts that you should understand before you believe anyone that would tell you that the interest loan rate will be offset by a dividend in the policy. Dividends, number one, are declared by the board of the insurance company, and they're the profits of the insurance company, and it is not what is being paid to policyholders. Let me repeat that. Dividends are declared by the board annually, and though they might declare it like a 5 or 8% rate, that is not necessarily the rate that is paid to policyholders. Dividend rates are not what policyholders earn on their cash values. If an insurance company declares a 5 to 8% dividend, they may still need to deduct mortality cost expenses and commissions. And we've cut a podcast about that with an insurance company executive talking exactly how different companies report their dividend rate, and some do not take the mortality cost expenses and commissions out of that before they report it. So it's important to know that before you start leveraging that policy so that you can know more about what the dividends are really actually going to be. Even though the final annual dividend is declared to be a certain percentage, this still doesn't mean that each policyholder will see that percentage rate of return in their cash values. And the reason for this is because the dividend is a percentage of what is shared among all the participating policyholders, and it has nothing to do with the compound annual growth rate or the cash value in any particular policy. So if there is a 5% dividend declared, that 5% then is divvied up to all the policyholders, and you may only get a fraction of that as a return rate in your cash value that year. Here's some guidelines that can help you maximize your cash value and your life insurance coverage. Number 1, only purchase life insurance that you can afford. Number 2, never purchase life insurance that you are not comfortable with owning. 3, be careful if you are told to leverage one policy to initially fund, pay the interest on, or sustain the premium of another policy. You could end up losing both policies if you can't afford the premiums or the interest that becomes due on those policies. Always plan to pay the interest on policy loans from your own income stream and not with borrowed money, even borrowed money from another policy. Number 5, never pay premiums with a policy loan, a line of credit, or other source of capital that requires interest payments unless it is for a short duration and you have a plan and the ability to repay that loan quickly and comfortably. Now, here I'm going to stop and say that I've often told people that I have policy loans that are outstanding on my policies that I don't ever intend to really pay back. Now, how does that line up with what we've just talked about here? Well, the thing is that those policy loans are, the capital from them are giving me a much higher rate of return than what the interest is that the policy needs to sustain itself. That means that the determining factor of taking a policy loan has nothing to do with the dividend rate of the policy and everything to do with the fact that I can make more money with that capital if I leverage my policy and take it and invest it someplace else. That's the spread that we're looking at, the difference between the policy loan interest and what I can earn on that capital when I leverage it, not the spread between the dividend and the policy loan rate. Because number 1, the dividend rate isn't an exact spread that we can figure and computate because that dividend rate is split between policyholders. And so if it's a 5% and the loan policy rate is 4%, the spread is not 1% because you are not earning 5% in your policy. You're only earning a fraction of that 5%, which was declared as a profit of the insurance company. Number 6, realize that the use of other people's money costs money. So never leverage your policy for a policy loan unless you are comfortable and can affordably pay the interest on that loan. Finally, keep the money you borrowed against your life insurance working for you in a way that will recover the cost of interest. Just like I shared in my example earlier, my capital is working and earning a higher rate of return than what the insurance company is charging me for the policy loan. And if you follow these 7 rules, you will allow yourself to profit the most and fully benefit from the dividends that participating whole life insurance provides. Have a great day. I hope this has been helpful. And you can always contact our office at 702-660-7000 for further clarification and understanding. Have a great day. Bye-bye.
Hey guys, thanks for watching this video. If you enjoyed it, please give it a thumbs up. Also click the subscribe button to enjoy the latest content and newest videos on the channel.